For years, Europe's most iconic cities were considered bulletproof investments, powered by cheap money and relentless demand. But beneath the surface, high interest rates, harsh new rules, and a global tech slowdown are exposing cracks. Now, 10 major cities face a data-driven reckoning. The evidence is undeniable. Which markets are about to fall first, and just how deep could this crash go? Dublin's rise as a global tech hub transformed its docklands into a magnet for high-earning professionals and investors. For years, the city's property market rode a wave of relentless demand, with names like Google and Meta expanding their Irish workforces and fueling a boom in high-end rentals. That momentum has now faltered. Since 2022, major tech firms with headquarters in Dublin have shifted from rapid hiring to cost-cutting, announcing layoffs and pausing recruitment. This abrupt change has filtered straight into the rental market. In tech-heavy neighborhoods, agents report a clear uptick in vacant premium apartments and longer wait times to secure tenants. Landlords who bought multiple units banking on a steady stream of tech professionals now face higher mortgage costs and the risk of empty properties. The days of easy returns in Dublin's Silicon Docks are fading. Lisbon tells a different story, one driven not by sector contraction, but by a sudden reversal in government policy. The city's property boom was supercharged by the Golden Visa program, which starting in 2012, offered residency to non-EU buyers in exchange for real estate investment. Thousands of apartments were snapped up, and a flood of short-term rentals transformed central Lisbon. In 2023, the government ended the Golden Visa real estate path and froze new short-term rental licenses under the Mais Habitação package. The effect was immediate. Real estate portals began reporting a surge in listings, especially in prime districts, as foreign investors rushed to exit. Luxury apartments now linger on the market, with analysts warning of a growing disconnect between prices and local incomes. In both cities, the old certainties are gone. Oversupply is building, but for very different reasons. Berlin's housing market, once the poster child for late-stage growth, is now buckling under the weight of higher borrowing costs. As the European Central Bank raised rates at record speed, German mortgage lending volumes collapsed. Official data from the Bundesbank show new housing loans fell by nearly 40% from their 2021 peak during the worst of the rate shock. The consequences have been swift and visible. Vonovia, Germany's biggest residential landlord, announced a freeze on almost all new construction not already underway, citing soaring financing costs and weak buyer demand. Adler Group, once an aggressive developer in Berlin, has canceled or postponed projects and is selling land to stabilize its finances. Even state-owned housing providers like Gewobag admit that many planned projects are no longer financially viable. With buyers unable to secure affordable loans and developers shelving new builds, Berlin's supply pipeline is drying up. It is an unmistakable sign of a credit crunch. Amsterdam faces a different but equally powerful pressure. The Dutch government's rollback of the 30% ruling, effective from January 2024, slashed the tax-free portion of expat salaries and capped the benefit. For skilled foreign workers, this means less take-home pay and a tougher financial case for relocating. Relocation agencies and HR managers now report a slowdown in corporate moves to Amsterdam, with more candidates turning down offers. On the ground, brokers and rental platforms like Pararius are seeing a growing inventory of high-end apartments, especially in expat-heavy districts such as De Pijp and the Zuidas. Listings linger longer, and landlords who once relied on a steady influx of well-paid expats are left searching for tenants. When both capital and talent pull back, the foundations of these city markets start to look increasingly fragile. If you value hard evidence over hype, now is the time to act. Subscribe for data-driven alerts that cut through the noise and keep you ahead of the curve. This channel is built for viewers who want more than headlines, who demand facts, not fear. Every week you will get market signals before they hit the mainstream, including official lending figures, policy changes, and credible insider reports that shape the future of European real estate. When regulations shift or investor sentiment turns, you will know about it. First, no wild guesses, no recycled rumors, just clear, actionable analysis. Whether you are a homeowner, investor, or just watching the market, staying informed is your best defense. Hit subscribe and turn on notifications to get the next alert as soon as it drops. The next wave of market moves is coming, and the best prepared are always one step ahead. Stockholm stands out for a different kind of risk, the quiet strain building inside household budgets. Sweden's central bank, the Riksbank, has repeatedly warned that Swedish families are among the most indebted in Europe, with household debt hovering near 180% of disposable income. Most Swedish mortgages are variable or fixed for only a short term, so when the Riksbank raised rates to fight inflation, the impact landed fast. In the city's condo market, families who stretched to buy at peak 2021 prices now face monthly payments that have doubled in just a few years. Court statistics show a rise in personal insolvencies and forced sales in Stockholm, numbers not seen since the last financial crisis. The pressure is not coming from developers or investors, but from ordinary borrowers caught in a rate trap. Debt is the key vulnerability here. Barcelona's fault line runs through City Hall. In 2024, the mayor's office froze new licenses for tourist apartments, following years of resident protests and legal battles. The city's leaders have called it a war on tourist flats, determined to reclaim housing for locals. Enforcement has become aggressive. Illegal short-term rentals face heavy fines, and entire buildings have been targeted for inspection. Landlord associations have fought back in court, but the number of legal tourist flats is now capped, and city data shows a drop in short-term rental listings. For investors who bought on the promise of endless tourism demand, the rules changed overnight. The result is a growing inventory of once profitable apartments, now struggling to find long-term tenants at pre-crackdown prices. In both cities, the vulnerabilities are clear, whether it is families overstretched by debt or investors blindsided by enforcement. The margin for error has vanished. Warsaw's property market, once buoyed by a wave of demand after the Ukraine conflict, now faces a different kind of uncertainty. The initial rush, driven by refugees and short-term rental needs, has faded and been replaced by a climate of caution. Institutional investor surveys in 2025 show nearly 7 out of 10 respondents now rate Poland as high risk for cross-border deals, and foreign direct investment in Polish real estate has dropped by almost 1/5 in just 1 year. Major capital flows are shifting elsewhere, with UK and German funds quietly reducing their Warsaw exposure, and prime yields widening to 5.75%, a sign that risk aversion is driving up expected returns. As a result, high-end residential listings linger longer, and brokers report a 12 to 15% increase in days on market for premium apartments. Without the steady inflow of global capital, local developers and sellers are left searching for buyers willing to accept the new risk premium. Manchester, meanwhile, is grappling with the aftermath of a speculative building spree that outpaced real demand, creating clear oversupply. The city's skyline filled with new towers on the promise of a corporate migration from London that never truly materialized. By 2025, only a fraction of the projected relocations had come through, and absorption rates for new apartments lagged far behind completions. Official figures show 4,000 new units delivered in a single year, but vacancy rates in city center high-rises have jumped to more than 11%, with some premium buildings reporting voids as high as 14.5%. The rental market has stalled, with average rents barely rising and sales prices dipping as much as 4%. Local authorities confirm that the development pipeline remains full, even as demand struggles to keep up. For investors and developers who bet on endless growth, the gap between expectation and reality is now impossible to ignore. Frankfurt's once prized office towers now stand as a warning to real estate optimists across Europe. By mid-2025, the city's office vacancy rate has surged past 17%, the highest of any major German market. Brokers describe a relentless tide of empty floors, driven by banks and consulting firms consolidating their footprints and embracing hybrid work. Even prime business districts, once immune to downturns, are now dotted with sublease signs and shadow vacancies. Germany's statistics office confirms that around 1 in 4 employees works from home at least part-time, a figure even higher in finance, the backbone of Frankfurt's high rises. As major tenants hand back entire floors, the city's commercial landlords face a glut that would have seemed unthinkable a decade ago. The Bundesbank and leading agencies warn that this oversupply, combined with higher borrowing costs, is dragging down capital values and putting leveraged owners under pressure. Meanwhile, Paris faces its own moment of reckoning. Years of global capital and ultra-low rates pushed the city's residential prices to their most stretched levels in modern history. The UBS Global Real Estate Bubble Index places Paris near the top of Europe's overvaluation charts, with the income needed to buy a standard apartment at record highs. But the foreign money that once fueled this boom is receding. Notary data show that non-resident and foreign buyers now make up a smaller share of transactions than before the last cycle's peak, especially outside the luxury segment. Today, Paris's market rests on domestic incomes that have failed to keep pace with prices. With foreign demand cooling and borrowing costs elevated, the city is left exposed at the very top of the cycle, no longer shielded by easy money or a global investor safety net. Europe's housing markets now stand on a knife edge. Official data shows price corrections already unfolding. For millions, this means volatility is not theory, it is reality. In uncertain times, information becomes the only real safe haven. The question now, who prepares and who gets caught by surprise? Join the discussion below.